Tonight, we start with a headline that should get everyone's attention. A financial tremor just rumbled across the Pacific. Not from an earthquake, but from Beijing. China has just sent its strongest signal yet about its massive holdings of US debt. This isn't just numbers on a spreadsheet. This is about power and leverage. The question: is China preparing to weaponize its financial might against the United States? Imagine the global financial system as a massive machine, with the US and China as its biggest gears. For decades, China's export-driven economy has accumulated trillions of US dollars, parking them in US government bonds, the safest place on earth. China became one of America's biggest bankers, creating a delicate financial codependency. But that balance is now being tested. The news broke quietly, then became a roar. China is making a strategic shift away from US debt. This isn't a panicked sell-off, it's a calculated move. It's a message from the highest levels of the Chinese government, one Washington cannot ignore. We are in uncharted territory. This goes beyond Wall Street. It's about the stability of the US dollar, interest rates, and the government's ability to fund everything from the military to social programs. When a major creditor like China hints at changing its investment strategy, the world listens. And right now, the world is holding its breath. Tonight we break it down. What did China do? Why? And how worried should you be? Let's get after it. First, what is US debt? Think of it as a government-sized credit card. The US spends more than it collects in taxes, so it issues bonds, IOUs, to cover the gap. Investors, including foreign governments, buy these bonds, lending money to the US in exchange for interest. It's considered one of the safest investments in the world. China, as a manufacturing powerhouse, earns a huge surplus of US dollars from trade. Instead of letting those dollars sit idle, China invests them in US Treasury bonds. This arrangement has worked for both sides. The US gets funding, China gets a secure return. China is one of the largest foreign holders of US debt, hundreds of billions of dollars. This gives China a unique position in the global economy, not just as an investor, but as a stakeholder in America's financial stability. If the US economy does well, China's investment is safe. If it falters, China's holdings are at risk. This is often called mutually assured financial destruction. Neither side can pull the plug without hurting itself. But the relationship is changing. Tensions over trade, technology, and global influence are rising. China's massive holdings of US debt are no longer just an investment, they're a tool of statecraft, a point of leverage. The question: would China ever use that leverage? The latest news suggests the old rules may no longer apply. So, what did China actually do? This wasn't a dramatic fire sale of US bonds, it was more subtle, but just as powerful. China allowed a significant tranche of its maturing US Treasury bonds to expire without reinvesting in new US debt. Instead, that capital is being redirected elsewhere. For years, China would automatically roll over maturing bonds, maintaining its exposure. But this time, a multi-billion-dollar block was simply cashed out. Sources say these funds are being diversified, some into gold, some into bonds from other countries. The message: China is actively seeking alternatives to the US dollar. This isn't a one-off event, it's part of a broader trend. China has been quietly reducing its US debt holdings for 2 years. But this latest move is different in scale and intent. A deliberate policy choice, not a market reaction. It signals a strategic de-dollarization effort. China is building financial firewalls, preparing for a world where its interests may not align with America's. The timing is no accident. Tensions over technology, the South China Sea, and trade are all simmering. By making this move now, Beijing is reminding Washington that the economic relationship is a two-way street, and that China has leverage. Why does this matter for Washington, or for you? China's actions directly affect the US government's ability to borrow money. When a massive buyer like China steps back, someone else must fill the gap. To attract new buyers, the US Treasury may have to offer higher interest rates. Higher rates for the government mean higher rates for everyone: mortgages, car loans, credit cards. It touches every part of the economy. Beyond economics, this move challenges the dollar's dominance as the world's reserve currency. If other countries follow China's lead, the dollar's global influence could erode. The Federal Reserve's job gets harder too. Less foreign demand for US debt complicates monetary policy. In short, China's move exposes a strategic vulnerability. A foreign power gains a lever over America's economy. To understand today's move, we need to look back. The US-China financial relationship was built over 4 decades, starting in the 1980s as China opened up its economy. China exported billions in goods to the US, creating a massive trade imbalance. The US got cheap goods. China got a mountain of US dollars. This arrangement, dubbed Chimerica, was symbiotic but unbalanced. China needed a safe place for its dollar reserves. US Treasury bonds were the answer. By the early 2000s, China was one of America's top foreign creditors, helping keep US interest rates low and fueling economic growth. But this codependency always had tension. US politicians worried about reliance on a rival. China worried about the safety of its investment. The 2008 financial crisis tested the system, but the dollar held strong. In the last decade, cooperation has turned to competition. Trade wars, tech sanctions, and geopolitical friction have frayed ties. Now China's US debt holdings are seen less as an investment and more as a potential weapon. The threat isn't a full-scale dump, but a strategic reduction, a subtle, effective way to exert pressure. What are the risks if this trend continues? First, rising interest rates. If China leaves the market, new buyers will demand higher yields, raising the cost of servicing America's $34 trillion debt. More taxpayer money goes to interest, less to priorities like infrastructure or healthcare. Second, market volatility. The Treasury market is the world's bedrock. If China makes unpredictable moves, it can spook other investors and trigger a domino effect. Third, the value of the US dollar. When China sells US bonds, it sells dollars, putting downward pressure on the currency. A weaker dollar can make exports cheaper, but if the decline is rapid, it drives up the cost of imports and fuels inflation. Finally, the long-term risk. China is promoting its own currency, the yuan, and building systems that bypass the dollar. If successful, America's exorbitant privilege as the world's reserve currency could fade, reducing US power and influence. Let's bring this home. What does it mean for you? If China's actions push up Treasury yields, mortgage rates rise. On a $400,000 loan, that's thousands more in interest over the life of your mortgage. Higher government borrowing costs could mean higher taxes or cuts to programs you rely on. The stock market hates uncertainty, and higher rates, your 401k could take a hit. When bonds pay more, investors may sell stocks, pushing markets down. A weaker dollar means imported goods, gas, electronics, clothes, cost more. That's inflation, a hidden tax on your wallet. So while the headlines are about global finance, the impact lands right on your kitchen table. We reached out to experts in finance and geopolitics. Dr. Amelia Thorne calls this a gray rhino, a large, obvious threat that's now moving. Beijing is testing its ability to disrupt US markets without hurting itself, a sophisticated form of economic statecraft. Marcus Vance, a former Treasury official, says the market can absorb this, but every uptick in yields costs US taxpayers billions. China isn't trying to trigger a collapse. They're inflicting 1,000 cuts, raising America's cost of capital. Professor Li Wei in Beijing says this isn't aggression, but prudent diversification. China is protecting its savings in a multipolar world. Treasury Secretary Janet Yellen projects calm, affirming the strength of US markets and the dollar. But the fact she had to address it shows the level of concern in Washington. So, how worried should Washington be? There's no need for panic. The US economy won't collapse overnight, and the dollar isn't losing its reserve status tomorrow, but ignoring this would be a grave mistake. China's move signals a changing world order. American economic dominance is no longer unchallenged. China is building leverage and insulating itself from US pressure. For Washington, this is a wake-up call. Our reliance on foreign capital is a vulnerability. The best response? Get our financial house in order, tackle the debt, promote growth, and strengthen alliances. Should you be worried, be aware, be informed, and pay attention to what our leaders do next. The strength of our nation tomorrow depends on the wise financial decisions we make today.